Welcome back to the Privatized Banking Project. Here's a question for you. Is your risk tolerance actually guiding your investment decisions or misleading them? Today, we're unpacking a concept that's been overused, misunderstood, and in many cases, downright dangerous: the idea of risk tolerance. The thesis: risk tolerance is a flawed framework, and there's a far better way to think about building a financial plan. First, let's define what risk tolerance actually means. Financial advisors often use questionnaires to measure your willingness to endure market volatility. Low score, you're told to invest conservatively. High score, go aggressive. Here's the problem: these assessments measure emotion, not strategy. They're snapshots of your comfort level in a vacuum, not your actual financial reality, goals, or capacity for loss. Second, risk tolerance ignores risk capacity, which is arguably more important. Risk capacity asks, can you afford to take this risk? Someone in their 30s with a 20-year time horizon has more capacity for volatility than someone in their 60s nearing retirement. But if that 30 something panics during every downturn, is risk tolerance really the right metric? This disconnect leads investors to either overexpose themselves or miss out on long term gains. Another powerful reason risk tolerance fails is that it promotes static decision making. Your life isn't static. Your cash flow, job stability, family structure, and goals all change. So should your investment strategy. A set it and forget it portfolio based on a 5-minute quiz won't serve you during job loss, recession, or an unexpected opportunity. What you need is a dynamic, principle based system, not a personality test. So, what's a better framework? We suggest focusing on risk alignment. That means matching your strategy to your goals, time horizon, liquidity needs, and financial obligations, with emotion as one of several factors, not the main one. Ask yourself, what's the purpose of this money? When will I need it? What role does this investment play in my overall plan? That shifts the conversation from comfort to context, and from vague feelings to clear decisions. Finally, risk alignment allows for more flexible, intentional planning. Instead of labeling yourself as conservative or aggressive, you build separate strategies for different financial buckets. Maybe your short term cash is in safe assets, your retirement fund is in indexed equities, and your speculative money is in private investments. Each has a purpose, and the risk is aligned accordingly. So the next time someone asks, what's your risk tolerance? Pause, because that question might not be asking what you really need to answer. The better question is, what are you trying to achieve, and how much uncertainty can you afford along the way? If you found this helpful, make sure to subscribe, like the video, and leave a comment below. Have you ever made a decision based purely on your risk tolerance? And did it work out? Here at the Privatized Banking Project, we're building financial freedom through clarity, not hype. Stick around, we've got more coming.